there are rules in life that you have to follow, right? You have to follow, or you should follow this RMD age. If you don't, there are penalties. We'll get to that in a little bit. So you feel like, okay, I'll sit back, I'll wait till 73, I'll take that. But in this case, there are some things you could do right now before age 73 to maybe lower that RMD, and that can really help your overall retirement.
Yeah, and this is why getting started planning sooner than later is always a good thing, because the more time you have on your side to implement strategies, it can really help you out. And we have a great example to demonstrate how doing some proactive planning can really help. So in our example, we have Paul, and he is not retired yet, but he's age 57. And he has $1 million in his IRA. And Paul's IRA, we're just going to make some assumptions. We're going to say that his IRA grows by a rate of return of 7%. And he doesn't need to use that $1 million because he has a really nice pension and he optimized his Social Security payments. So he's living on pension, Social Security. He's concerned about his health care costs down the road. He plans on living a long time. So he's allowing his $1 million IRA to grow by not taking distributions out. But wait a minute, he hits his retired minimum distribution age, which for Paul is age 75. And by that time he obtains age 75, his $1 million IRA has grown to $3 million, which means his required distribution is going to be about $122,000. So Paul's big surprise, which is a surprise for a lot of people once they get to that time frame, this is why we call the RMD age the tax ticking time bomb, because for Paul, as well as many others, it increased the tax rate that he is in at that time because he has his pension. He can't turn his pension off, doesn't want to anyway. He has his Social Security, doesn't want to turn that off. So he has this base of taxable income, and now he adds another $122,000 to that base. That's going to kick him up into the next tax bracket, and basically that is going to be his tax bracket forever unless his $3 million IRA balance which decreases his RMD. But if you calculate the $122,000 versus a $3 million balance, that's about 4%. That's about a 4% distribution. So he takes out 4%, his IRA grows more than that, then the next year's required minimum distribution is going to be higher, and they also require a higher percentage as Paul ages as well. So Paul's RMD future is looking bleak because he didn't do anything from 57
just kind of
to 75.
Keep growing. If you had a graph with the tax bill, it would just keep going up and up.
It's just going to keep going up. So that was option A for Paul, but Paul didn't go with option A because he wanted to do some proactive planning. So what Paul did is he engaged in some Roth conversion strategies from age 57 all the way up to age 75. So the Roth conversions he did, he took money from the pre-tax IRA, shifted it over to the Roth IRA, and once that money's in the Roth, it grows tax-free forever. He did have to pay taxes on the amount he converted in the year he converted, but what it did for Paul is it allowed his IRA balance at age 75 not to be $3 million, it was $2 million based on his conversion strategy. And what that does for Paul is it decreases his required distribution all the way down to about $81,000, which is about a $41,000 difference between option A and option B, which Paul ultimately went with. So a couple things there. One is he has more control over how he takes money out of his IRA because he still has a mandate. He has to take 81, but 81 significantly less than the 122 in the option A scenario. So control over his money was really important to Paul, but also now he has a contingent of his retirement money that is invested in the Roth that is growing tax-free forever, which gives him even more control down the road over taking money from his Roth that is tax-free. There's not a required minimum distribution from his Roth, which really significantly decreases his required mandate and, again, gives him more control over when and how he takes his retirement money out.